Good afternoon, everyone. My name is Art Alvarez with Mortgage Works, where we have the answers and they're on the house. Welcome to this week's Mortgage Minute, coming to you from Palm Springs and the greater Coachella Valley area. Happy to report we've got great weather, mid-80s, sunny, not a cloud in sight, dry warmth, so very, very comfortable. So hopefully that'll help me continue with the show feeling pretty good today. I usually touch on sports, and it's an interesting sports week, right? Had the start of the NBA here a couple of days ago. We got the World Series coming up tomorrow. And at the risk of offending some of my viewers, I'd like to see Toronto pull this off. I think that would be kind of interesting. At the least, as I've said many times, I sure hope it goes to 7 games, because that's really what makes a World Series so special, is get all the way through a 7-game series and go right down to the last game, and it's a real nail biter, and the games are close and maybe lose by 1 run. So I'm really, really hoping for that. And then that news this morning about the kind of a bombshell report about the FBI and the Southern District of New York going after some people with illegal gambling, poker, I guess, and maybe fixing some NBA games, and even a couple of well-known NBA player coach, being arrested. Wow, that was a shocker. And when was the last time anybody heard about the mafia? So to hear that the mafia may be involved in this and that they're back in the news, wow, that was quite a surprise, and it's going to be very interesting to see how that plays out. So with that, let's go ahead and get into what's going on with the bond and mortgage markets. We like to show you our rate grid first of all from our website. And, it's interesting. I attended essentially a trade show yesterday in Rancho Mirage with the California Desert Association of Realtors, their fall summit. And I had a table there and, passing out our materials and talking to agents and so forth. And I had a rate sheet there. And I made sure to point out to everybody who came by our table that everything on our rate sheet is in the 5s, as you can see here on the rate grid, at least in terms of first mortgages. Yes, second mortgages, HELOCs, HELOC loans are a little bit higher than that, in the 6s and from there. But, this is really, really good news that, contrary to what the media tells you, at least at Mortgage Works, we can offer you a variety of loan programs for first mortgages that are in the 5s, as you can see from that rate grid, going from the conforming conventional 5 7/8, the temporary buy downs from those from that loan product where you can start in the 2s or 3s, FHA, VA now in the mid 5s, 15-year fixed, very low 5s, and even jumbos now are under 6%. So that's really, really good news. And so with that, let me go ahead and show you the chart for the 10-year bond yield for the last 5 days. It's actually up just slightly today. You can see last week it was under 5. In fact, got down to 3.95. And then, of course, it's gone up. And again, this is actually a 1-day chart. Pardon me, it's not a 5-day chart. But you can see it started off at 3.95 to open the market. We're a little bit above that at right around 4. But it's been kind of right in the 398 to 402 for all of last week going into last Friday. So in that respect, part of the reason I think the bond yield is so stable right now is really because of the lack of data for the markets to react to. So let me go ahead and go to that slide and kind of give you an idea of what's going on in the market that might have an effect on bond yields and therefore mortgage rates. As I put there on the first bullet point, the U.S. data point desert desert continues. And all I mean by that is, the U.S., there's a U.S. economic calendar that any of you can access so that you can see what kind of data points are going to be released week to week. And so, again, pulling that up for this week, several data points are supposed to be released this week, but they haven't been. For example, initial jobless claims, that was supposed to be due out today. 225,000 claims are forecast, but we don't have the data. The report was not released. What was released today existing home sales, and it was forecast to be 4.06 million versus 4 million in September. And you know what? It hit 406 on the dot. So the forecast was accurate. Slightly better is good news, but there's some reports that home buyers are still pretty skittish. 4.06 million is certainly better than last month, better, I think, than July, when I think we were under 4 just a little bit. But, a more normal situation, again, that's a national number, is closer to 6 million. So we still have a ways to go on that. The CPI, now that's actually scheduled for release tomorrow. The annual rate is forecast to be at 3.1%, so slightly up from August when it was 2.9. And if you recall from last week, that CPI number was supposed to be released last week. It didn't happen, and they actually brought in some sort of temporary staffing in order to crunch the number to get it released by tomorrow. And the reason for that is we need to get it published in order for the Social Security cost of living adjustment to be calculated. So that's an important item, of course. And so that's why temporary staff were brought in order to get that, calculated and released, because it will affect the Social Security benefits for any of those folks out there getting Social Security income. So that, that was a special adjustment made just, to get that number out. And then tomorrow, new home sales are forecast to be 710,000. They were 800 in August. Part of the reason for that having to do with the fact that, as we talked about here in the last couple of weeks, home builders, particularly in that August number, had done a substantial amount of concessions to their buyers. And of course, that was at the expense of their bottom line. But home builders, I'll tell you, and I've mentioned this to you before, they're very, very focused on keeping their inventory moving. They'll do whatever they can from a financing standpoint to entice those buyers to sign those contracts. In August, that was at a fever pitch. They were offering all kinds of concessions, buy downs, closing costs, combination of the two, that did get that number up quite a bit in August. It was a surprise number. But now, of course, in September, it's expected to settle down, because after the hit to their bottom lines, I think some of these home builders are backing off a little bit on the concessions, not a whole lot. They still kind of lead real estate in that regard over the existing home sale markets, where concessions, while are more prevalent now, are not necessarily seen as much in the resale markets as we see in the new home market. So with that, I want to go into a couple of things, some information, some data, not these data, U.S. economic data point releases, but other data that's out there that'll give us a little bit of insight as to what's going on with rates and for the possibility of rates falling. And as you can see on the headline on this screen, will Fannie Mae and Freddie Mac help them plunge? So I want to get into a little bit of the technical aspect of what that is all about, because there has been some headlines about that. So on the next screen, I want to show you again what that information is. First of all, what is MBS? MBS is mortgage-backed security. Again, I mentioned before, almost all mortgages serve as collateral for bonds. That's why the bond market is so important to track where mortgage rates are going, because almost all mortgages, in particular the government insured or guaranteed mortgages, are collateral for bonds. In that case, they're called Ginnie Mae bonds, Government National Mortgage Association bonds. So it's important to know what an MBS is. So what hit the news this week is a letter was sent to the Treasury Secretary and to the Federal Housing Finance Agency Director, Secretary Bessent, Director Pulte, not to be confused with Pulte Homes, two organizations, the Community Home Lenders of America and the Independent Community Bankers of America, sent a letter requesting that Fannie and Freddie start purchasing up to $300 billion in mortgage-backed securities. The reason they are asking for this is they pointed to the fact that right now, the spread between a 10-year Treasury bond yield, which you saw on our earlier screen, was about right at 4%. The spread between that yield and a conforming loan, a conforming Freddie Mac, Fannie Mae loan right now, is about 222 basis points. That's, in other words, that's about 2.25%. Again, 4% Treasury bond, 10-year bond, at a 2.25 spread to that. That means a conforming mortgage rate, 30-year fix, about 6.25. So that's where we're at in terms of the current spread. The problem with that is that the normal kind of traditional customary spread between 10-year Treasury bond and a conforming Fannie Mae Freddie Mac mortgage, 30-year mortgage, is more like 140 to 170 basis points. In other words, more like 1.4 to 1.7% spread. So these two organizations are basically have contacted Fannie and Freddie saying, hey, look, the spread's too wide. We need to see that spread narrower to get these mortgage rates lower to help with affordability, to spur more people to buy homes. And again, these two agencies, or these two organizations, I should say, what their argument is that right now the GSEs, that's what Fannie and Freddie are known as, the government-sponsored enterprises, they have caps as to how much mortgage-backed securities they can buy and hold at any given time. So both of these organizations pointed out that Fannie and Freddie are $246 billion below their MBS purchase caps. And the idea here is if they stop that, they start buying these securities, that would help reduce mortgage rates by potentially as much as 0.30%. And that, of course, would be an important move and a very beneficial move. Now, they are arguing that Fannie and Freddie should only buy more MBS when the spread is above 170 basis points. So right now it's about 222 basis points. So these two organizations are saying to Fannie and Freddie, look, start buying these MBSs. You're way below your cap. And if you do that, you're going to help get these mortgage rates lower to help mortgage affordability for home buyers. Now, this is sort of similar to, and I'm trying not to get too technical here, but the same kind of process goes on with the Fed. You may have heard the term quantitative easing. Well, back when we had the pandemic, in particular in early 2020, in fact, March of 2020, the Treasury bond market, the MBS market was getting very dysfunctional as we were starting to, see the government shutdown occurring, a different kind of government shutdown than we're dealing with now, but just, I should say, the economy shutting down essentially because of the pandemic. And so what the Fed did at that time is they pursued a quantitative easing policy. And what that was for was to create a lot more liquidity in the economy. So the Fed was buying bonds, Treasury bonds, mortgage-backed bonds, in a very aggressive way. So they were pouring lots of liquidity into the economy, given basically the shutdown of the economy due to the pandemic. And of course, that worked very well for a period of time. But ultimately, what it helped do also was to trigger inflation. And so by early mid-22, the Fed said, okay, wait a minute, I think we've done enough to create abundant liquidity. And so they decided to then reverse course, and it became known as quantitative tightening, where they slowed down their purchases of Treasury bonds and mortgage-backed securities. And then even the ones they had purchased, they let them come to maturity and let them roll off their balance sheet without replacing them. So, of course, what that did is it did help start to push inflation back down, but, of course, at the expense of raising rates in a very significant way. So with that as a backdrop, again, these two organizations have urged Fannie and Freddie to consider buying these mortgage-backed securities to help get these mortgage rates, even though they're better than they have been, get them down even lower. And part of their concern is there appears to be some decline in investor demand for mortgage-backed securities. And so as a consequence, they're looking at Fannie and Freddie as essentially the GSEs acting as a buyer of last resort to help keep these mortgage rates where they're at now, and even better, get them a little bit lower. So we'll see how successful they are with their request. I think it makes some sense, given the fact that both agencies are below their caps. They are in a position where they can buy more mortgage-backed securities. So let's keep our fingers crossed that they consider that request seriously and maybe go ahead and pursue it, because I think if they do, we could see some rate improvement here soon, which I think will be a little bit more direct than what we are anticipating is going to happen with the Fed and the Fed funds rate. As you may know, we're expecting a couple more rate cuts before the end of the year. So just be aware of that. That's what hit the news this week. Let's see what happens there. Now, then the next slide, what I'm going to show you or talk about a little bit is a couple things: inventory and pricing. Of course, as it says at the top, mortgage rates are near 2025 lows. That is true. And we do have potential Fed rate cuts coming up next week. Expectation is the Fed could lower the Fed funds rate another 0.25%. There's a little bit of an increase in the futures market about Fed funds that maybe we could see as much as 0.5%. I'm not sure I would agree with that. I think 0.25% is, probably pretty much built in, is on the table as going to happen. But we also know from the last decrease last month, when we went down 0.25%, there was really virtually no impact on mortgage rates in terms of going lower. In fact, right after that Fed rate cut, mortgage rates went up about 0.1%. Now we've gotten that back. Right now, the 10-year bond's back to that 4% level. But right after September's rate cut last month, the 10-year bond was slightly below 4 for about an hour, and by the end of the day, it was at close to 4.10, and by the next week, it was in the 4.15 range. So now we've clawed and gotten that back. We're back to the 4 range. So we'll see again if this rate cut next week, if it is 0.25%, what's going to happen again. I suspect the improvement back to around a 4% 10-year bond yield is again in anticipation of the Fed's additional 0.25% reduction. And if that proves to happen, then of course we could see the 10-year bond yield creep up again, and without any direct immediate benefit in mortgage rates in general. That's why that on that previous screen, those two organizations asking Fannie Mae and Freddie Mac to buy more mortgage-backed securities may be a more direct tool to get mortgage rates down in a quicker fashion. Now, on the second point, and this is all stuff that's you can read on the business news, you see it on CNBC, or go to the business page online, whether it's CNBC or Yahoo or any of these business news outlets. They're all talking about right now the average mortgage rate locked in is at about 6.35, slightly below what it was at the slightly below the previous week, and close to the lowest of all, 6.32 in all of 2025. I like to point out, though, that as you saw on my rate grid on our website, we're already below that. We're in the high 5s. So keep that in mind if you're shopping for a mortgage. Don't let anybody tell you you're going to get a rate over 6 if you have a good credit score, good down payment. Don't let anybody tell you that without getting a quote from us, so I can show you that we very likely could do better. And again, you see on there the next bullet point: Federal Reserve cut end of October, expected to be a 0.25 point reduction. Bank of America, big name, they obviously follow the economy pretty closely, right? They're expecting the September CPI to rise 0.3% month over month, year over year about 3% also. And of course, I covered that on our previous slide. Now, mortgage bankers, Mortgage Bankers Association, are now observing, we are seeing, and I'm very happy to see this, and I'm doing my part to try to help with this, we are seeing a little bit more tendency for sellers, and I don't mean just home builders, they do this all the time, but we're starting to see more evidence of sellers of existing homes understanding that concessions can help them sell their home. So we are seeing more, at least anecdotal evidence, and certainly in terms of the business we're doing, we're not only seeing it, we're helping make it happen, where we're seeing sellers are now more inclined to offer some credit, some concessions to help that buyer with their mortgage rates. And as the next bullet point points out, permanent fixed rates in the 4 to 5 range. Over the weekend, on Sunday, I got a call from a home builder that we are a preferred lender for, and I provided some numbers for a prospective buyer of one of their lots where we were going to use a seller incentive of $40,000 on a, believe it or not, a condo in Northern California that was priced at nearly $1 million. And with that $40,000 concession, I actually put together several scenarios for that prospective buyer, one of which was to use that incentive and permanently buy down their FHA rate. Yes, believe it or not, $1 million condo in Northern California, being able to buy it with a 3.5% down payment, FHA financing. I then showed them how they could use that incentive to permanently buy down the rate, 30-year fix at 4.75, and they still had money left over from that $40,000 to cover most of their closing costs. So can you imagine that? Buy an almost $1 million condo with nothing more out of your pocket than your 3.5% down payment, and end up with a 30-year loan at 4.75%. So yes, that we are seeing more of that, and that's what we're trying to do to make sure that that is at least considered by both the seller and the buyer when they're trying to negotiate a purchase. And the idea here is that by using these concessions, not in a lower price, but in a seller credit of dollars, then we can use that toward the buyer's financing. That's a much more effective strategy to keep their payments down, as the last bullet point points out. It's often better savings than just lowering the price by $10,000 or $40,000. Yes, that's going to lower your payment versus a full price offer. But if you take that concession, not in price, but in dollars, let us show you how we can use that toward your loan and get much, much better results in terms of lower monthly payment, in terms of less cash out of pocket to complete that purchase, because your closing costs in many cases can be very much, more than half covered, sometimes almost all covered, and yet still get a buy down too. So that is something that's now becoming more prevalent in the resale markets. Every time I get a request to pre-qualify a buyer, I'm almost always now told, they were going to offer some amount below list. And then I always ask for permission to at least show them how they can use that concession, not in a lower price, but in seller dollars as a credit, and then show them how they can get their financing much improved by using that. And you know what? In a majority of cases, I'm able to convince that buyer to shift gears, offer full price or nearly so, and then get those concessions in dollars, apply it to their loan, and they're going to be much better off in the long run and going to have a much more affordable payment as they begin their journey into home ownership. So on the next page, what I want to do, and this is a little bit more about inventory and pricing and at least what we call moderate opportunities, and that is housing inventory. Housing inventory has increased. In our local market here, it's approaching 4.5 to 5 months based on the current sales rate. That's getting pretty close to normal. Nationally, in August, 4.6 months. Again, it wasn't that many months ago when inventory was lower than that. It was more like 2 to 3 months based on the sales rate. It has increased. There are more homes for sale. That means you, as a buyer, you have more options to consider when you're out there shopping for the home. Now, as a seller, what that also should be telling you is you have more competition in getting your home sold. Now you don't have just the home builder down the street that offers these tremendous incentives in terms of rate buy downs, closing cost credits, or both. You now have more competition from other sellers of existing homes. And you should take note of that if you're a seller, because you've got to compete with that. And in doing so, you might want to consider using the home builder's playbook and figuring out ways to offer some incentives to get your home sold. So keep in mind, again, the inventory is up 11, almost 12% year over year. And that, again, is going to be, I think, give the buyer a little bit more advantage, or at least a little bit more leverage in negotiating a good deal. And it should cause the seller to make note of that and realize you've got more competition. The other thing that's going on, and I think it's in part because of more inventory, home price growth has slowed. Now, we haven't gone into negative territory in any significant way in virtually any market. Yeah, a few micro markets, there has been some net reductions in the average price level. But overall, we are still seeing home prices appreciate, going up, but at a slower rate. Again, as the bullet point indicates, it gives you more gives the buyer more negotiating power. And we're seeing this in particular in the South and in the West. Price growth barely above 1% in many of these markets in the South or the West. And because of the dropping rates, average monthly payments have gone down since May to about $250 a month. And of course, that number really, in a lot of cases, doesn't take into account what you can do in getting those concessions and buying down those rates and therefore those payments even more. That $250 number is really more about what's happening with the increase in inventory, the reduction in rates since May. The combination of the two, I think, is helping that average monthly payment to go down by that amount. But again, we can show you how that monthly payment amount can go down even much, much lower if you use those concessions in a different way. Now, this last couple of bullet points I almost chuckle at. VA FHA loans remain attractive. Again, I put that on this slide because I saw some news articles on the business page, promoting that, kind of broadcasting the fact that, hey, FHA and VA are a good deal because they have a relative rate advantage over conforming conventional loans. That is true. And I've said before on this program, FHA is one of, if not my most favorite loan program, that I think still is sort of underappreciated. And I think in a lot of cases, not considered seriously enough when you're trying to decide how to finance your home purchase, because of the fact that FHA provides a tremendous rate advantage over conventional conforming loans. Now, in these news stories, these headlines, I saw things like VA rates are right around, on average, 5.819. FHA rates right around 6.084. Guess what? I don't know where you're going to get rates like that for FHA and VA loans. Please go to my website, look at the rate grid on the homepage. You can see that today we have 5 3/8 as an FHA rate with no points. VA in the same range, right around 5 3/8 to 5.5. Again, with no points. So yes, VA FHA rates are better. They have improved. They do provide you, in most cases, and virtually all cases, a rate advantage over a conventional conforming loan. But the rates that you can get, at least if you call us and at least ask for a no obligation quote, you're going to see much better than what we have in these news headlines, in these news stories that I put on this slide. You can definitely get a VA loan more like 5.5 or lower. FHA, definitely 5.5, 5 3/8 is where we can offer right now to help you get that home purchase done using either one of these two loan products. So keep that in mind. I tell people all the time, look, you should be able to get an idea of what the cost of that loan is going to be, what the price is on that FHA, VA, or conventional loan that you're looking to get to buy a home. You should know those numbers up front. You don't need to apply for a loan to get specific numbers. Call us, call me. I can give you with some very basic data that I do need from you. Price of the home, what's your offer price, what's your loan amount or down payment, and therefore your resulting loan amount that you're going to get with that down payment. What are you going to use the home for? What is your credit score? I can basically put together very detailed worksheets to give you all that information so you know what your closing costs are going to be, at least estimated what they're going to be, what a breakdown of your monthly payment, taxes and insurance, principal, interest, HOA dues, if that's involved. I can give you all of that before you apply with us or before you sign a purchase contract. Why wouldn't you do that? So you know the price of the financing that you're going to need to complete the purchase. Don't let any other lender tell you, oh, sorry, I can't give that to you right now. You got to apply for the loan first, and we'll tell you later in 2 or 3 days. No, it doesn't have to work that way. We can give that to you up front. Call me. I can send you the information by email, and no obligation. We don't charge you anything for that. If you like what you see, we expect you'll come back to us. If you don't, or you decide you still got to go with whoever else you're talking to, that's fine. But I at least want you to be informed of what's really out there in terms of financing terms, because in a lot of cases, I would argue in most cases, we can probably offer you a better deal. So keep that in mind. So there you have it. There, kind of a current summary of what's going on in terms of financial news as it relates to the mortgage market and what's going on in terms of trends with mortgage rates, property inventory, and property values. In fact, heads up, next week will be the next Case-Shiller index release. So we'll be interested to see where that goes and what that tells us about home prices. I expect it's still going to tell us that home prices are still going up, albeit probably at a slower rate as we've seen for the last few months. So with that, I want to go ahead and go into our next and last segment, what we've added to this program lately, and that's our product spotlight. And so in this one, what I'm going to do is I want to cover something that I think is sort of oftentimes, in fact, most of the time, is kind of under the radar when you're shopping for a mortgage to buy a home. And in fact, even if you're shopping for a mortgage to refinance a home. So in fact, consider this. When you've shopped for a home, you have, well, here's the headline first. 20 is the new 30, the overlooked loan term that might be your best move. So with that, consider this. You're shopping for a mortgage to buy a home. Chances are you've probably been told about a 30-year loan or a 15-year loan. Those are usually the two options that most lenders are going to show you. But there's another option that most lenders don't even consider bringing up, or at least letting you know is available so you can make a more informed decision. And that is the 20-year mortgage. The 20-year mortgage can be a very good compromise, sort of the middle lane between these other two options, the 30-year and the 15-year, because it's going to give you faster equity buildup. You're going to incur less interest cost over the term of the loan, and the payments are still manageable. And that's important to know because, many times I've been asked, to provide some quotes on a mortgage to buy a home. And when I do that, usually we'll start with the 30-year. And a lot of times I'll have the prospective buyer say, well, you know what? I understand 15-year loans have a lower rate. Can I see that option? So I provide that. And I'll tell you what, 9 times out of 10, probably 9.5 times out of 10, once they see that higher payment on that 15-year loan, yeah, it's great. The rate's lower by usually quite a bit. There's a lot less interest paid over the term of the loan. But when they see that monthly payment, wow, it spooks them. In almost every case, they say, well, duly noted, thank you for that. I'll stick with the 30-year. But that's why I believe the 20-year is sort of that hidden, almost secret option that certainly with me, I'm trying to tell people about more and more. So let me show you some numbers just to illustrate what I'm talking about. So what I did here is I'm providing you some numbers based on a $500,000 loan amount. Okay. And so the first thing I want to show you is the standard 30-year fix, right? Right now, of course, based on our rate grid you saw earlier, 30-year loan, no points, 5 7/8, $500,000 loan amount. What's your principal and interest payment going to be? $2,958. Now, over the life of the loan, the full 30 years, you would incur $565,000 just in interest cost. So, of course, the argument with a lot of folks will be, well, wait a minute, I'm borrowing $500,000. I've got to pay that back. And then I got to pay $565,000 of interest as well. I'm paying more than double my loan amount in interest. Oh my gosh, that's terrible. Well, that's true. But let me give you a little hint. I understand that analysis. Yeah, it's worth considering. Yeah, you should be aware of it. I will tell you that in a majority of cases, you'll never incur that $565,000 of interest. The reason? Because a majority of borrowers, when they get that $500,000 loan to purchase a home, particularly if it's their first home, the probabilities are you're never going to pay that 30-year loan to term. You are not going to make 360-month payments and still have that house 30 years later that is now free and clear. In a majority of cases, particularly in California, that is a rarity anymore. In fact, the average life of a mortgage, in terms of what in the industry technically is called prepayment speed, it's more like 7 to 10 years is the average length of a mortgage before it's paid off. And of course, it can be paid off because you're selling your home, because you refinance the loan, maybe a couple of times if rates keep dropping. There's a variety of reasons. You win the lotto and you just want to pay it off. There's a variety of reasons why in a majority of cases, when you get that 30-year mortgage, you're not going to pay the full 30-year term. That's very, very unlikely. So don't get too worked up about that $565,000 of interest that you're going to incur if you make all 360 payments. All right, so with that little tip, let's look at the 15-year loan. 15-year loan, yes, the rate's much better, 5.125. $3,987 a month principal and interest. That's $1,000 a month more. That's why, as I said earlier, virtually every case when I'm giving somebody quotes on a 30-year loan, because they say that's what they want, but then they say, hey, wait a minute, I hear the rate's a lot better on a 15-year, and you can see that it is. And then when they see what the payment is, like, oh, never mind. I don't want to pay $1,000 a month more, even though, yes, I understand the benefit in terms of a lot less interest. And you can see it there, $218,000 of interest over the life of the loan. So that's why, at least initially, a 15-year loan seems like a great idea. A lot of folks have interest in that option, and in part because they look at the full 180 month term and they say, well, guess what? It's going to be less than half the interest as a 30-year loan, and I'm not paying more than double my loan amount in interest with that option. Sure, that's true. But the trade-off is, can you comfortably handle $1,000 a month more in your principal and interest payment? Even if you're able to qualify for that $1,000 a month more payment, which in many cases that borrower who's inquiring about a 15-year loan, and we find out, well, they can't really afford it based on debt ratio anyway. But even if they can, a lot of times they say, well, wait a minute, I don't want to pay that much more. And what that really means is they don't want to be locked into paying that much more month in and month out. So sometimes the reply is, well, I'll stick with the 30-year, but I'll pay some extra on my own in order to reduce the interest cost. And yeah, that is an option. Or the other thing that folks will look at doing is, well, I'll go with the 30-year loan and then set up a biweekly payment and be able to pay less interest that way, which is an option, but I don't think is the best option. And the reason I say that is because of, on the bottom here, the last one, 20-year loan. Now look at this. A 20-year loan gives you a substantial benefit in rate over a 30-year, just like the 15-year loan does. 5.25, not quite as good as a 15-year, but really very, very, very close. 5.25, 20-year fixed. Your monthly payment is going to be higher than the 30-year loan. Yes, $33.68. That's a lot more reasonable, a lot more manageable than that 15-year payment. And so when you consider that and the fact that, yes, you're going to pay a lot less interest over the 20-year term, $309,000, again, still a little bit more than half your loan amount, but certainly not double your loan amount, that becomes something that you go, wow, hadn't really thought of that. Hadn't really heard about that very much. Here you are, right here. You can see the 20-year loan, again, sort of that hidden option that a lot of us in the mortgage industry, I think, do a poor job of telling borrowers about. This can be a great, great middle lane, sort of middle of the road trade-off between you're trying to, keep your payments manageable. You'd like to pay less interest. And most importantly, you'd like to accelerate the rate of wealth creation, of increase in equity. And that's the important thing to note. A 20-year loan is going to give you less interest and manageable payments, and that equals faster wealth creation. It's a better strategy than a biweekly 30-year loan. In fact, just to remind everybody, how does a biweekly loan structure work? Why does that reduce your interest cost on a 30-year loan? Well, basically, when you're doing a biweekly payment schedule, what you're doing is you're taking half your monthly payment, dividing it by 2, and then paying that amount every 2 weeks. Well, that's 26 installments. Well, if you think about a monthly payment divided by 2, and you pay that 26 times, what that means is at the end of the year, you're paying 13 monthly payments. And yes, that does reduce your interest cost, but if you pay that out to term, it's not going to lower your interest cost down to the 20-year level. It's going to lower it, but you're still going to take about 23 to 24 years to pay off the loan. So that's why I don't think the biweekly payment option on the 30-year loan, the 30-year loan option or choice is as effective as just going with the 20-year. Now, yeah, over the term of the loan, you're going to pay about $2,000 a month more than a biweekly payment, but I think that's a pretty reasonable trade-off and save more interest and shorten the term even below that 23 to 24 down to 20. So with this information, what I would encourage you to do, if you have any interest in getting a mortgage right now, if you need to get a mortgage to purchase a home or even on a refi, if you want to see the numbers, how that plays out, reach out to us. I can, again, put together for you a worksheet to give you all the numbers and show you how the 20-year loan really could be the new 30. It's the overlooked loan term that might be your best move. Let me show you how, and I think you'll be very well pleased. And if you're able to qualify for that, I think it's a great option for you to get that, loan purchase, that home purchased, and be able to have the great combination of less interest costs, manageable payments, and greater, faster wealth creation. Okay, with that, I think we have concluded the program. I want to thank everyone for watching and listening to this week's Mortgage Minute. My name is Art Alvarez with MortgageWorks. You can see all my contact information on the screen. Feel free to check out our website. Look at those rates from time to time, day to day, week to week, just to keep track on what's going on. And again, if I can help you in any way, providing you some numbers for almost any scenario, please reach out to me. I'd be happy to have a discussion with you, get you those numbers, give you some guidance about what's the best option in terms of financing, and hopefully help you be successful in achieving home ownership and building your wealth. So with that, have a good weekend. Stay tuned. Look for that World Series starting tomorrow. Have a good weekend, and we'll see you next week on the next edition of the Mortgage Minute. Thank you.